Welcome to the IT Investor Podcast, where we help tech professionals like you turn your W 2 income into lasting wealth through real estate investing. I am Pramod Gudishetty, your host, a data engineer and a real estate investor.
Yep, and I'm Wally Taylor, your co-host, and I'm also a fellow IT investor. As we all know as tech workers, we work long hours, we're juggling tight deadlines, deployments, data pipelines, deliverables. What if our money could work just as hard as we do? We have one query today to rule them all. We're going to talk about passive versus active real estate investing.
Yes, today we will dive into active and passive investing. We are going to break down the risks, rewards, and give you some real life scenarios. Having said that, Wally, do you want to start off with what active income really means?
Yeah, let's start with that one that we all know way too well. That's our active income. It's that 9 to 5 paycheck, and it's directly tied to the amount of time and effort we put into our work. We show up, we do our work, we get paid, right? And if we work harder, maybe we get an increase or a bonus. But the moment that we stop working, guess what happens to that income? That income, it stops too.
Exactly. I like the way how you put that analogy, Wally. And as an IT professional, we earn money by writing code or managing cloud environments, fixing production issues, or analyzing data. It's like working on call for a system that never sleeps. And if you shut down, nothing gets processed, no code runs, no money flows in, right?
I love that. Yeah, active income is like an on-demand server. The second you shut it down, game over. On the other hand, passive income, that's a different story. That's the setup where our money's working for us, even when we're doing the things that we like, right? We could be enjoying a hobby that we love or spending time with our kids or just relaxing on the weekend. Whatever it is you love to do, you're not working, but you're still earning.
That's the dream, right? Building wealth quietly in the background. Whether you go active or passive, the goal is same. Stop trading time for money and start building income streams that don't depend on you clocking every day.
Yeah, our old buddy Robert Kiyosaki said it best. Don't work for money, make your money work for you. And that's exactly the goal that we're chasing. All right, Pramod, let's paint a picture, everyone. Let's talk about active investing for a second. What I like to call the DIY route. So we'll say that John is a seasoned Java developer, and he decides he wants to buy a single family home as a rental property. He does everything he's supposed to do, saves up 20% down payment, qualifies for mortgage, finds a great tenant, he thinks, and on paper it looks solid, right? Every month the rent rolls in and we're cash flowing. That's what we want. But reality checks in. What really happens as a single family rental owner? Tenant might not pay rent for a month or two, and now you're sitting with no income and you're paying the mortgage still. Or even worse, you have to deal with an eviction and you're paying costly legal fees. Maybe it's middle of July and the AC breaks, and now you've just come out of pocket 10 grand for a new AC unit. Let's say the lease ends and you don't have somebody ready right away to move in when the other tenant moves out. You may go a month or two without income. And on top of that, once the tenant does move out, there's also additional turnover that you have to spend to fix up the property for the next tenant. New carpets, paint some things, make those minor repairs. It's not all what it's cracked up to be.
Wow. Looks like now John is spending his weekends troubleshooting or fixing and chasing down the contractors and maybe trying to find new tenants, as you mentioned. And looks like his savings are all draining also at the same time. The passive investment is now actually looking like a second job for me.
Exactly. John is spending a lot of time with those 3 T's we talk about a lot in real estate investing. That's the toilets, the termites, the tenants. So what's the solution there? Maybe he could hire a property manager, and that's okay. It's going to help. It's going to help kind of manage that property for him. But now he's got to manage that property manager, and on top of that, it's a 10%, typically a 10% piece of that rental income. So now his margins are tighter, and the stress really it's still there.
Yeah, that's right, Wally. The stress is still there, even though if you hire a property manager, at least in my case, I have seen that really happen because not all property managers view the property as their own, right? I mean, you really have to vet them and find the exact property manager. And also, you need to be in constant communication with them. Okay, now let's say, Wally, if John scales, say 5 times more, I mean to say, let's say if he buys 5 more properties across the town and now he is juggling with 5 different mortgages, maybe 5 property managers or worse, he's trying to self manage. And 5 sets of tenants made their maintenance requests and unexpected headaches. At this point, John doesn't have a passive income. He is now having a real estate job. I will say that. And for most of us who are in tech, we don't have the luxury of so much time. This is more time consuming and it needs a lot of energy for that.
Yeah, absolutely. Trying to hold down our regular W-2s and spend time with families or the things we like to do. There's just no time for a second job. Active investing, it can work, but it's not for everyone, right? Most of us, we enjoy our daytime jobs. And I think if we picked up another active investing role, there would definitely be some burnout there because it's time and it's but let's think about this another way. Let's switch it up for a second. Let's say John takes that down payment money that he put towards that first single family rental, and we'll just call it $50,000. And we'll say he invests it passively in a 100-unit multifamily syndication. Pramod, can you guess how different that's going to be for John?
Ah, yes, that's easy now. Now he has no tenant calls because the property is professionally managed by the property managers. He gets to enjoy the consistent cash flow. And since the investment is in a 100-unit multifamily, even though if 5 tenants are not paying or 5 tenants are vacant or whatnot, there is the remaining 95 which will provide the cash flow, and he gets to enjoy his time back, spend time with his family, and he can concentrate on his tech job. And the big one is he gets to enjoy the major tax benefits by the year end that lets him keep more of what he has earned.
Yeah, Pramod, this is like switching from babysitting a fragile app in a prod environment to maybe watching robust infrastructure just hum in the background. And no panic alerts, just quarterly investor distributions that hit your bank account regularly.
Life is so easy now, right? And that's what we are here after. Income that works for you while you live your life. Wally, I love the idea of passive investing. Just send the money and then check your account. But of course, due diligence is needed. That's where we come in to teach our viewers how to evaluate deals, how to read between the lines, and invest smartly. Also, Wally, we hear in real estate a lot about GPs and LPs, general partner and limited partners. Can you tell our viewers who a general partner is and what are his roles and responsibilities?
Yeah, absolutely. So we almost kind of described that GP and LP roles theirs with our example of John, the JavaScript developer. But yeah, the general partnership group, that's the management group of the syndication. Those are the folks that are the active real estate investors, and they have different responsibilities. But make no mistake, each one of those is going to be a grind. It is a full-time job. There's going to be the acquisitions person, or it could even be a group that they're working actively with brokers in their area. They're finding that deal flow. They're doing the underwriting on those deals. Sometimes it's like finding that needle in a haystack, right? You could underwrite 100 properties, maybe 5 of them actually turn out to be good deals, and out of those 5, you only submit an LOI on 1 or 2, and eventually selecting one as your final investment property. You've got your asset managers; that's a GP role. That's the group or the person that's involved with the property management company. That's kind of the babysitter over the property manager. I shouldn't say that, but essentially, yeah, yeah. They're also the person that's in charge of working with the general contractors that you have in place for doing property maintenance. A lot of times the apartments you buy, they need to be brought to newest market conditions. So they're working with those general partners. There's another general partner role that's the investor relations. That's what Pramod and I do most. We help find investors that are interested in investing in these multifamily properties. So we're responsible for communicating with those investors the deals that we have. And then also, once a deal's been selected, we're responsible for communicating the progress of the business plan on those projects, and most importantly, making sure that those distributions take place. So those are some of the general partner roles, the more active roles of multifamily syndication. So I kind of took a little dive there on the GP role, but Pramod, can you tell us a little bit about the LP role?
Yeah, sure. A limited partner is a silent investor, Wally. I mean, all he has to do is to just invest the funds and wire the funds wherever the GPs request. And after that, he just need to sit back and watch the show as the experienced team does the heavy lifting. He has no phone calls to attend. I mean, to say he doesn't need to take phone calls from tenants, handle their issues, no late night stress. He only has to check his bank accounts for passive income, say every quarter, if the distributions are quarterly. And on the year end, he receives a K1 So he just need to use that K1 to file his taxes to take the advantages. So Wally, how should someone figure out if active or passive investing is better fit for them?
Yeah, you really got to ask yourself, do you have time to shop for deals, underwrite? I made that example earlier of underwriting on 100 properties and winding up just picking just one. Do you have time to be that active property manager, or I should say the asset manager? If you enjoy hands-on being with tenants and contractors, maybe the active investor or GP role is right for you. The GPs do make a little bit more money on a syndication deal. So if you're chasing those high returns in exchange for putting in more work, maybe that's the way to go. And then a lot of folks, they're okay with lower effort gains. And these are just one of the many questions you kind of need to ask yourself when deciding whether you want to do active or passive investing. Really, if real estate is your passion and you want to be in control, active investing is the way to go. And if you would rather focus on maybe your 9 to 5 or other activities outside of that besides being hands-on in the property itself, then passive investing is going to be the way to go. Myself, I started as an LP investor, learned the ropes, and as I built more confidence in multifamily syndication and the general partner roles, I later transitioned into one of those roles.
Okay, thank you, Wally. Speaking of numbers, I ran actually a scenario recently and this blew my mind. This is going to be quite interesting. So let's say like if you invest 50K per year for the next 5 years in a solid cash flowing multi-family deal, and we all know that in these deals generally the distributions are 8% a year. So you start collecting $4,000 a year in your disbursements. Okay. And we also know that these multifamily properties, they sell, they have an exit strategy, and most of these exit on the fifth year, usually. So, what I'm saying is, if you invest 50K per year, for the 5 years, and after the 5 years have completed, I want you to reinvest those profits from sixth to the future years. So in 12 years, what I saw is like you will be making a 1 million mark in just about 12 years. And the kicker is that you would be getting disbursements of over 90K per year. I saw this example and this really blew my mind. So for viewers who are listening to this, we will be providing a link to this spreadsheet so that you can do the math yourself. Now, Wally, I wanted to mention that passive investing isn't just limited to multifamily. There are other powerful asset classes like the mobile home parks, the self storage facilities, land development, new apartment development, oil and gas investment. And I would personally definitely not invest in the stock market because of the volatility, and historically it has averaged only 10% gains. So having said that, Wally, can you wrap up with the advantages of passive income?
Yeah, I'll try to wrap up the advantages of passive income. Essentially, we're making our hard-earned money work for us while adding an additional stream of income through those quarterly distributions. Real estate also has great tax benefits that minimize our taxable income, things like depreciation and cost segregation that we'll discuss later in future podcast episodes. But the biggest gain is actually when we sell the property after that 5-year hold period and we get to cash out that equity. Pramod, can you give somebody the blueprint for what they need to do to start investing passively?
Yeah, sure, Wally. The first step is to decide your why. I mean, what you want actually. Is it freedom, family legacy, or you want to add additional stream of income? The second step is to choose your lane. Among the different real estate asset classes, you have option to invest in multifamily, mobile home park, storage, all those different asset classes. The next step is to vet your partners. You really need to do your due diligence and invest with people whom you believe and trust and who are transparent. The fourth step is to deploy your capital smartly. Do not put all your eggs in one basket. I will say start with 50 to 100K in a deal. And the last step is to automate and review. Do your quarterly check ins and check your annual growth. So that's the blueprint. Now, if you're ready to make your money work as hard as you do, hit that follow button and subscribe and connect with us. Whether you choose active or passive investing, the key is to start now. As Warren Buffett said, if you don't find a way to make money while you sleep, you will work until you die. Thanks all for hanging out with us today. Until next time, keep building wealth.
See you soon.
Thank you.